Good morning and welcome to Finance for Non-Financial Managers. My name is Sue Schmidt and I'm your instructor today. So let's go ahead and get right into the material. So let's start with our context model. As you all know, what you bring to the table here today is more important than anything else that I can teach. What you are all going to do today is learn from each other. You have a tremendous amount of experience and expertise that you have picked up from the factory floor, working with other people in the business. And when we mix that with all of the key concepts we're going to talk about today, our current business environment, today's marketplace and financial objectives, the different processes like the budget process and creating standard costs and variances, as well as the key terminology and cost behavior that we'll talk about today, okay? When we mix all of that together, the result is, I firmly believe that you will all walk out of here with a much better perspective on how you impact the bottom line. Okay, so let's get started with some key financial terms and definitions. We want everybody to be talking the same language. All right, so I have three financial statements here. We have the balance sheet, the P&L statement, also called the income statement or profit and loss statement, and the cash flow statement. And here I have them all linked. And they're linked for very good reasons, multiple reasons in fact. First and foremost, there's no single transaction. Well, that's not true. There are some transactions that do affect just one financial statement, but the majority of transactions do in fact affect two financial statements or possibly all three financial statements at the same time. So they really are linked, okay? In addition to that, it is impossible to get a good perspective on the profitability, the overall financial health of a company if you don't look at all three of these financial statements. So if I'm a bank deciding whether I want to loan you money, or I'm an investor deciding if I want to invest in your company, I am going to look at all three of these statements. All right, a little bit more about them. The balance sheet. The balance sheet is always done as of a snapshot at one point in time. And it shows the overall financial health of the organization. Okay? I can create a balance sheet today, I can create one at the end of the month, at the end of the year, and I always do. And it, as I said, it shows the financial health of the organization, and it goes on and on and on forever as long as this business exists. Okay? The second one, the P&L statement, also called the income statement more commonly, is a statement that covers a period of time. Could be a month, could be a quarter, and always a full year, all right? So it covers a period of time, and it shows the overall financial performance of a company over that period of time, okay? So balance sheet is financial health, P&L statement is overall financial performance. All right, the last one is the cash flow statement. Now, I know cash is important to all of us. Well, it's just as important to every single company. In fact, there is an entire financial statement dedicated to cash. What the cash flow statement shows is where did cash come from and where did it go out of the company? Did it come from our daily operations? Did we borrow money? What did we spend it on? Did we buy large assets? Did we just pay our bills? Et cetera, okay? You can tell a lot about a company and their overall financial health as well by looking at their cash flow statement. Okay, let's move on. Okay, a little bit more into the profit and loss statement, the P&L statement, since all of you in the audience today do primarily have an impact on cost. That's going to be our focus today, more on the P&L statement. So as I said, it's a financial statement that measures a company's profitability and performance over a period of time. On it includes revenue or sales, and most of your sales come from the sale of goods. I believe you do sell some service in terms of repairs, but the majority of it is for goods, right? And expenses. By definition, an expense is called the usage of an asset. but it's merely what we spend our cash and our assets on in helping the business run our daily operations, okay? So that's what an expense is. All right. One such expense is called a depreciation expense. We have large assets. Large assets, whether they be furniture, equipment, buildings, things like that, that we don't expense at one point in time, and I'll get to that in a moment. I want to talk about a very specific principle, okay? But over time, we expense them, and that is called depreciation. So before I move further, I want to talk about the matching principle. It's the only principle I'm going to talk about today, but it's so important to us as accountants on what we do and what goes on our financial statements and how we record the transactions that I want to talk about it today. Okay? So the matching principle simply states we have to properly match our expenses with the applicable revenue that we had incurred the expenses in earning that specific revenue. Okay? So that's what it says. And let's go through an example. So let's open a Starbucks, shall we? All right, so we're going to open a Starbucks. So we go out and we rent some prime property, okay? It's in an ideal location. And we start making purchases. We buy all kinds of coffee inventory. We buy the barista, a lot of equipment. We install shelving. We have the whole place painted, new lighting, those cute little teddy bears that we sell for all the different holidays, and the mugs and all that great stuff, okay? So it's the end of, let's say, February, and we're not opening until April 7th, okay? So it's the end of February, and we spent all this money. So what do you think our financial statements are going to look like at the end of February? They're going to be terrible, right? They're going to look awful. We're going to have buyer's remorse, wondering, why on earth did I do this? Okay, so let's move on to March. We do the same thing, right? We actually now are hiring people, and we're doing some training. We have utility bills, rent, some salary expense, still finishing up on making the place look beautiful. The end of March, we do a financial statement. We do a P&L statement. How does it look? Again, it looks terrible, right? All right, so now we go to April, and we're opening our doors. And of course, we're Starbucks, so the crowds come rushing in, the balloons go up in the air, and we start selling great cappuccinos and frappuccinos, and we had a lot of coffee inventory and stock, so I didn't buy any of that this month. I did pay some salaries. I had to pay my rent and utilities, okay? But I didn't buy anything else for the store. So what do you think my P&L statement's going to look like this month? It's going to look fantastic, right? Because I'm going to have all this revenue because we picked a perfect spot for this Starbucks, okay? And I'm going to have all this revenue and I'm not going to have as much expense. So the point I'm trying to make, that if I look at just February, and I look at just March, and I look at just April, I will not get a true picture over the profitability of this business. What I have to do is look at them all together. And the reason why we have a problem is because the expenses we incurred in February and March were incurred in trying to earn revenue that we earned in April. So the matching principle says that we're going to actually defer a chunk of those expenses in one way is using depreciation. So what we do is we take our large assets like our barista and all of our equipment and all of our furniture and our leasehold improvements, and we put them on our balance sheet as assets. And then we depreciate them over time. Our coffee becomes inventory, again an asset, and we do not allow it to drop to the bottom line. Instead, we hang on to it, and as we use it, we expense it, thereby matching the expense with the revenue, okay? We do a ton of this in accounting to ensure that revenues and expenses are matched properly, all right? Okay, cost Cost of goods sold is in fact the cost of our inventory or your inventory that you manufacture. As a pharmaceutical company, you'll manufacture and you will then put that on your balance sheet as inventory. It's an asset. We don't allow it to drop to the bottom line. But when we do sell it, it's called cost of goods sold. Okay? It's not ours anymore. It can't be an asset to me. I ship it out the door. It becomes an expense called cost of goods sold. You have another term here called cost of goods manufactured. And cost of goods manufactured is simply not found on any financial statement. For all of you, it's simply the total cost incurred in manufacturing your product. That's it. Okay? All right. We have a simple calculation here of what profit looks like. So we have a sales price minus a standard cost, minus the standard cost equals profit. So here's an example. The sales price of a widget is $14. The standard cost of that item is $8. When you subtract that out, we make $6 on every single widget that we sell. All right? If you take that $6 and divide by the original sales price, you're going to get a percentage, and that percentage is called the gross margin percentage. In this case, it's 43%. So, what do you think of this margin that we're looking at here? Do you think that's a good margin, 43%? Would you like to make $6 on every single widget that we sell? Yeah, it looks pretty good, right? It looks pretty good. Well, I got some bad news. Because it has to be that good. In fact, in your business, it has to be even better. That's because... Thanks, dogs. Thanks a lot.